Greetings, investors. My name is Joel Elconin, and I'm the co-host of Benzinga's PreMarket Prep show. After the close on Tuesday, the most recent round of 13F filings were revealed to the markets. Since not all investors are familiar with this term and the implications of it, I'm going to take a few minutes today to discuss that with you. Form 13F is shorthand for an SEC filing that large investors, banks, mutual funds, insurance companies are required to report to the SEC. If any of these institutions or managers have a position over $100 million in a particular issue, their trading activity in that issue must be disclosed to the SEC. Since it's quarterly, the positions, the activity that is revealed reflects a period going back. Let's take example of Mr. Buffett's disclosure of adding to his position in Apple shares. The trading activity for Mr. Buffett occurred in October, November, and December, when Apple actually traded in a much lower range between 103 and 118. This was adding to an original position that Mr. Buffett had acquired earlier in 2016 when Apple traded between $92 and $108. Let's look at the immediate impact in the marketplace after the close on Tuesday. Apple shares were bid up to a new all-time high and ended up closing at a new all-time high as well. Unfortunately for many of the investors that purchased that stock on Mr. Buffett's revelation in his 13F, they may not be getting the same price execution as he did when he purchased the shares. So now we know what a 13F filing is, who is required to do it, and the time period when the actual transactions took place. I'm Joel Elconin for Benzinga.